Supply and demand zones are critical concepts in Forex trading, rooted in the principles of price action and market psychology. These zones help traders identify potential areas of price reversal or continuation, offering a strategic edge in entering and exiting trades. Understanding these zones involves recognizing where large market participants, such as banks and financial institutions, place their trades, leading to significant market movements. A supply zone is an area on the chart where selling pressure exceeds buying pressure, causing the price to fall. It represents a price range where sellers are more likely to enter the market in large quantities, anticipating a decline in price. In a nutshell, it's a stronger and more dramatic resistance level. Price do a retracement down at a resistance, while price would do a complete reverse in trend at a supply zone. A demand zone is an area where buying pressure exceeds selling pressure, causing the price to rise. This zone indicates a price range where buyers are expected to step in heavily, leading to an upward movement in price. To put it short, it's a more advanced version of support, which could result in the end of a downtrend and the starting point of an uptrend.
Enough! You are all of you beneath me. I am a god, you dull creature, and I will not be bullied by that.
Examine past price movements to identify where significant reversals or consolidations occurred. These areas often serve as strong supply or demand zones. High trading volume at certain price levels can indicate the presence of strong supply or demand. Volumes often spike in these zones due to the increased activity of large traders. Patterns such as double tops bottoms, head and shoulders, and other reversal formations can highlight potential supply or demand zones. Supply zones often coincide with resistance levels, while demand zones align with support levels.
As you can see right now, we are in full margin right now. We are selling gold right now. I'm telling you guys, let's see what's gonna happen. The signal is out to the group right now. It's only 450 to join. Let's see, guys. This is NFP. This is NFP. This is NFP, guys. Let's see what's happening, guys. Me, I'm going full margin. I entered this long time ago with my people in the group, so we are getting in full margin. Let's go, NFP way. Let's go, guys. Let's go. 1 minute left, guys. Let's see what's gonna happen with NFP, guys. Let's milk NFP today, guys. I'm not doing this alone. I'm doing with people in the group, guys. We are all milking right now. It's 1 minute, guys. I'm telling you, guys. Just look at this. We are selling right now. Look at this. 1 minute. Okay. What's up? What the? Oh, shit. Yeah.
The stronger the price movement away from the zone, the more significant the supply or demand level. Zones that have been tested multiple times without being broken tend to be stronger. The longer the price stays within a zone before moving away, the stronger the zone is perceived. High volume at the point of departure from the zone suggests the involvement of major market players. Enter trades at the supply or demand zone. For a demand zone, buy when the price approaches the zone with a stop loss slightly below the zone. For a supply zone, sell when the price reaches the zone with a stop loss slightly above it. Trade the breakout when the price moves significantly past a supply or demand zone, indicating a strong trend continuation. Wait for the price to break through a zone, and then enter a trade when the price retraces back to the zone. This strategy anticipates that the zone will now act as a support or resistance. Place stop-loss orders just beyond the supply or demand zone to protect against false breakouts. Adjust the size of your trades based on the distance between the entry point and the stop-loss to manage risk effectively. Avoid overconcentration in a single currency pair or zone. Spread your risk across different pairs and zones. Supply and demand zones reflect the collective sentiment of market participants. A deep understanding of these zones can provide insight into market psychology. Traders must wait for the price to reach these zones and not rush into trades prematurely. Discipline in adhering to your trading plan is crucial. Reversals at supply and demand zones can be volatile. Maintaining emotional control and not deviating from the planned strategy is essential. Suppose EUR/USD has a significant supply zone at 1-2000, where the price previously reversed several times. A trader might place a sell order around this level, expecting another reversal. If GBP/USD shows a demand zone around 1.3500, where it has previously rallied, a trader might place a buy order near this level with a stop-loss below the zone. Examining the flow of buy and sell orders in the market to predict where supply and demand zones might form. Understanding how large financial institutions trade can provide deeper insights into the formation and strength of supply and demand zones. Using different timeframes to identify major and minor supply and demand zones. Higher timeframes often provide more reliable zones. Supply and demand zones are vital tools for Forex traders, providing a structured approach to identifying key areas of potential price reversal or continuation. By understanding and effectively utilizing these zones, traders can enhance their market analysis, improve entry and exit points, and manage risks more efficiently. Mastery of supply and demand zones requires a blend of technical analysis, market psychology, and disciplined trading strategies. If you found this video helpful and want to learn more about mastering the Forex market, be sure to hit that subscribe button to join our community of aspiring traders. We release lots of valuable content like this, so don't miss out on any of it. Thank you for watching.